All right, my scaly squad, listen up. We've got a juicy financial story brewing that's sure to get your investing senses tingling. Brace yourselves, because today we're diving headfirst into the bold move by MPACT, one of Singapore's biggest real estate investment trusts, to divest their Mapletree Anson office tower. Now, I know what you're thinking. Why would they want to let go of such a prime piece of real estate? Well, my reptilian friends, that's exactly what we're going to unravel in this video. We'll peel back the layers of this strategic decision, dissecting the rationale behind it and analyzing the potential impacts it could have on MPACT's financial position, portfolio optimization, and future growth prospects. But that's not all. We'll also explore the potential risks and rewards of this divestment, helping you decide whether it's a stroke of genius or a risky gamble that could leave investors feeling a little cold-blooded. So buckle up, my fellow iguanas, because we're about to embark on a wild ride through the world of REITs, asset management, and financial maneuvering. So, what are you waiting for? Get those investing muscles flexed and ready, because we're about to dissect this deal like the hungry iguanas we are. Let's dive in. Mapletree Pan-Asia Commercial Trust, commonly known as MPACT, is a real estate investment trust that has a diversified portfolio of properties across key gateway markets in Asia. One of the properties in their portfolio is Mapletree Anson, a 19-story office building located in the Tanjong Pagar area of Singapore. This building, which was completed in 2009, has been a significant part of MPACT's portfolio. Recently, MPACT made the strategic decision to sell off Mapletree Anson. This decision may seem surprising at first, but it is part of a larger strategy to optimize their portfolio and focus on their core assets. The sale of this property is not a sign of financial distress, but rather a calculated move to strengthen their financial position. The proceeds from the sale of Mapletree Anson will be used to pay off some of MPACT's debts. This is a common strategy used by companies to reduce their liabilities and improve their balance sheets. By reducing their debt, MPACT can lower their interest expenses and increase their financial flexibility. This puts them in a stronger position to take advantage of investment opportunities when they arise. Moreover, the sale of Mapletree Anson allows MPACT to focus more on their core assets. These are the properties that generate the most revenue for the trust and align best with their long-term strategic goals. By focusing on these assets, MPACT can ensure that they are maximizing their returns and delivering value to their shareholders. Let me break this down in simpler terms. Imagine you have a collection of different toys, but some of them are not really your favorites anymore. You decide to sell off those less loved toys to make some money. With that money, you can then buy new toys that you really want or save it for something else. That's essentially what MPACT is doing here. Mapletree Anson is not considered a core asset for them anymore, so they're selling it off to get some cash. With that cash, they can pay off some of their loans, which is like paying off your debts. This will make their overall financial situation stronger and give them more flexibility to make other moves in the future. Indeed, the sale of Mapletree Anson by MPACT is not just about reducing debts. It's also about improving their financial health in a broader sense. Let's delve a bit deeper into this. The leverage ratio is a key financial metric that measures the amount of debt a company has in relation to its assets. It's essentially a measure of financial risk, showing how heavily a company is financed by debt. When MPACT sells Mapletree Anson, they are reducing their total debt, which in turn improves their leverage ratio. This is akin to an individual having a healthier balance between their liabilities, what they owe, and their assets, what they own. An improved leverage ratio indicates a lower financial risk, which can be more appealing to investors and lenders. In addition to the leverage ratio, another important financial metric is the interest coverage ratio. This ratio measures a company's ability to meet its interest expenses on outstanding debt. It's calculated by dividing a company's earnings before interest and taxes, EBIT, by its interest expenses. When MPACT sells Mapletree Anson and uses the proceeds to pay off some of their debts, their interest expenses decrease. This leads to an improvement in their interest coverage ratio. In simple terms, it's like an individual finding it easier to make their monthly loan payments because they have less debt to service. Indeed, the decision by Mapletree Pan-Asia Commercial Trust, or MPACT, to sell off Mapletree Anson is a strategic one that reflects their commitment to optimizing their portfolio. This move is akin to a homeowner deciding to sell off a piece of furniture that no longer fits their home's aesthetic or function. It's about making space for something new and better aligned with their current needs and future aspirations. Reducing their debt burden is another significant aspect of this decision. It's comparable to an individual deciding to sell off unused or unnecessary items to free up cash. This not only declutters their space, but also improves their financial health. It's a practical move that many of us make from time to time in our personal lives. The sale of Mapletree Anson also positions MPACT for future growth opportunities. With a healthier balance sheet and improved financial metrics, they are well positioned to seize any advantageous investment opportunities that may arise. This is similar to how freeing up physical and financial space in our personal lives can open up new possibilities and opportunities. However, as with any transaction of this magnitude, there are always risks and considerations involved. These could range from market conditions and timing to regulatory approvals and transaction costs. But from what we know, it appears that MPACT has done their due diligence. They have considered all these factors and negotiated a fair price for the property, ensuring that the transaction is not just financially sound but also beneficial in the long run. Based on analyst reports and research, the divestment of Mapletree Anson by MPACT is expected to positively impact the REIT's stock price in 2024. The key factors contributing to this outlook are: 1. Improved financial metrics. The sale proceeds will be used to reduce debt, lowering MPACT's aggregate leverage ratio from 40.5% to around 37.6%. This deleveraging should improve MPACT's credit metrics, making it more attractive to investors. 2. Accretive to distributions. Analysts estimate a 0.9% to 1.5% accretion in MPACT's distribution per unit, DPU, for fiscal years 2025 to 2027. Higher DPU could drive up demand for MPACT's shares. 3. Portfolio optimization. Divesting this non-core asset streamlines MPACT's portfolio, enhancing financial resilience and positioning it for future growth opportunities. A more optimized portfolio could boost investor confidence. 4. Improved interest coverage. MPACT's interest coverage ratio is expected to improve from 2.9 times to 3.3 times, indicating better ability to service debt obligations. 5. Positive analyst views. Analysts from DBS and Morningstar have generally positive views on MPACT's prospects after the divestment, which could attract more investors. However, broader market conditions, investor sentiment, and MPACT's overall performance will also influence the stock price. Moody's negative outlook on MPACT's operating performance could temper the positive effects of the divestment. Overall, the divestment is seen as a strategic move that could improve MPACT's financial position, distributions, and portfolio quality, potentially leading to a positive impact on its stock price in 2024, provided the REIT navigates the challenges highlighted by Moody's. Alright, my scaly friends, that's a wrap on our analysis of MPACT's big move. Whether you think it's a stroke of genius or a potential pitfall, one thing's for sure: staying on top of these financial maneuvers is crucial for any aspiring investor. If you found this video insightful and want to keep leveling up your investing game, do me a solid and smash that like button. It really helps a cold-blooded reptile like me out. And if you haven't already, hit that subscribe button and ring the bell to join my ever-growing tribe of savvy iguanas. Remember, investing is a marathon, not a sprint, so stay patient, stay hungry, and keep learning. I'll catch you next time with another dose of financial wisdom, straight from the mouth of your favorite investing iguana. Peace out, my scaly squad.